You expect the next 10 years to have lower returns and
Once again, ladies and gentlemen, boys and girls and children of all ages, you are now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button if you are catching this live. But this is a late night, early morning show. It is 2 a.m. in the morning in Denver, Colorado. And that means it's probably 4 a.m. around on the East Coast. And on the West Coast, I think that's about, midnight? So I don't expect that many people to be catching this live. And I kind of like these little sneak in shows that I do at nighttime because sometimes this happened during the middle of me reading. And during the middle of me reading, I read some interesting things and I grab some interesting content. I like to share it. I'm not really flustered with a whole lot of things going on. But let me go ahead and say this. If you haven't done so already, go ahead. Hit the subscribe button. Hit the bell icon. Hit that like, comment, and share button. So in this video, we're going to be talking about Charlie Munger. He warning about the upcoming stock market returns of 2021 and all the way to the next decade, 2021 to 2031. 21 to 31. So we always know people love to say in the world of investing, I think Warren Buffett made this famous when he said the rearview mirror is always clear, but it is the windshield that is foggy. So, and that's saying that, hey, we can look behind us and look at what the stock market did and things like that, but we're looking in front of us, what's going to happen next. So, if you don't know who Charlie Munger is, he's the right-hand man to the world's greatest stock investor, Warren Buffett. He's been there for, I don't know how long. He's older than actually Warren Buffett. He's 97 years old. And I think Warren's about like 91. So he put out some very interesting things that I took notes on that I wanted to share. So I'm going to be playing a video and I'm going to be giving commentary throughout this video. So I want y'all to stay tuned. So let's start this off with, I think this was an interview with, I think it was Yahoo Finance, but he was at his home. So it was during the pandemic. He would look like he was at his home in California. And they kind of did a little zoom in with him to talk about, I think it's coming to one of his shareholders meetings. So, he's going to be talking loud. They're going to be in LA for the shareholders meeting, but let's go through this and let's see what Charlie Munger gives some very gems that he's going to drop on this particular topic of the next decade. All right, let's start playing. I'm going to pause it to give y'all some commentary. Here we go.
you expect the next 10 years to have lower returns in the equity markets than the last 10? He doesn't give us an idea why.
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
All right. Now he just spoke that he said, hey, I don't think that the market will be the same as it was in the past. Because we look at the past and we say, man, look, from the last decade, from 2008 all the way until 2020, when we experienced the pandemic, the market had done about 300-400%, if I'm not mistaken, from its bottom to its top. We had a decade of everybody saying a roaring decade of the stock market doing amazing returns. So what happens is everybody wants to get involved. So we look back in the 1900s. So we look at not 1900s, but early 1900s to the 80s, the 70s, the 50s, the 40s, and we like to look at that today and say, man, I wish I would have jumped into this. People are saying that right now, as we're coming out of the pandemic, people are looking at, man, look at those airline stocks just double. Look at the restaurant stocks just double. Look at, everything is just doubled. If you invested last year, you did pretty good. But, we're moving into a new economy now. And so we want to look at the old people and see what they're saying. So the first thing he hit on, one of the things he hit on was accessibility. He was like, everybody has access to the market now that they didn't have before. So back then, they're talking about accessibility to the market. You had to have a stockbroker. You had to pay a big transaction fee to get things done. But now everybody has apps. Everybody's jumping into it. Everybody wants to run into it. And it takes us back to after World War I, we rolled into the Roaring 20s. The World War I ended in 1918 or 1919, one of those. So when the war ended, now you've seen the economy go into a boom. After every war, we went into a big boom in the United States, at least, and we led into the 20s. And what happened after the 20s? That led us into 1929 until we led into the Great Depression. Because what happened in 1920s, the Roaring 20s, as it referred to, everybody said the market was just going up, up, up. People borrowed money, got into the market. It was just a way of life. And doesn't it kind of feel like that today? A lot of people have money on their hands. A lot of people have time on their hands, and they have accessibility. Everybody's running into the market. Everybody, you can't, you go on Instagram, Facebook, YouTube, whatever, Twitch, wherever it is, and everybody just knows everything. They want to tell you how much money they made off of Bitcoin. They want to tell you how much money they made off of this. And I want to say, if you study your history, you get to see this happen in the 20s. Another thing that he mentioned was real returns. What are real returns? Real returns is returns after you take out inflation and taxes. So as we already know, inflation is a hot topic right now. You have very low interest rates, and you also have us pumping money into the economy. So he spoke about accessibility. We have increased accessibility. Everybody is in the market now. Everybody is very optimistic about the market. Number two, we have real returns. He spoke about real returns declining. So when he could speak of real returns, he could say, hey, we could be in an era of higher taxes, because as everybody know how Trump looked on corporate taxes versus President Biden looks on corporate taxes. Then he looked at inflation. Everybody's worried about inflation. Why is everybody worried about inflation? Because we went into the stimulus packages. We just had a stimulus package. Last year, the Fed chair, Jerome Powell, lowered interest rates, and now this is our third round of stimulus checks. So when you are printing money like crazy, pumping money into the economy, very low interest rates, that usually is going to raise the price of goods and services, what is the definition of inflation. So if you made 10% return last year and you're like, oh, I made 10%, but if inflation was 12%, how much was your real return? It was a -2, right? So that's what he's speaking about going into the next generation. He spoke about accessibility. Then he spoke about your real returns going into the next generation that we have. So those are some key things that he said there. Let's listen to some more. 1 second here.
What do you think of the combinations of quantitative easing and large fiscal deficit, and where are they going to lead us?
Well, there I've got a very simple answer, and that is, it's one of the most interesting questions anybody could ask. And we're in very uncharted waters. Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire.
All right, so he's talking about quantitative easing. Quantitative easing was made kind of popular during the Obama administration by then Fed chair by the name of Janet Yellen. She was the Fed chair, and now she's the Secretary of Treasury. But quantitative easing is pretty much just printing money, pumping into the stock market, printing money, pumping into the stock market. That's what we did to get out of the 2008 crisis, and that's what we're repeating right now. So he asked Charlie Munger, what do you think? He was like, hey, we're in uncharted territories. We've never seen us print this much money without having some ramifications. So, yes, it worked for us in 2008. Now, as we're printing this much money, guess what? Everybody's worried about the interest rates and inflation, which is a big day today, as the Fed chair Jerome Powell will be releasing. He's going to shift the market today with whatever he says with inflation and interest rates. So, listen to from a 97-year-old guy saying that, man, I don't know, with all this printing of money that we're doing, I've never seen somebody print this much money in the history of the world, economics, and not have to face some type of repercussion. So what's he got to say?
Is the NASDAQ in a bubble?
Well, nobody knows when bubbles are going to blow up. Just because it's NASDAQ doesn't mean it'll have another run like this one very quickly again. This has been unbelievable. Again, there's never been anything quite like it. If you stop to think about it, think what Apple is worth compared to John D. Rockefeller's oil empire. It's been the most dramatic thing that's almost ever happened in the entire world history of finance.
Now, what he just spoke on there, they said, hey, do you think the NASDAQ is in a bubble? And he said, look back in my generation when John D. Rockefeller Standard Oil was the largest company in the world versus look at today when Apple is the largest company in the world. Apple today is at $2 trillion, if I'm not mistaken, at this recording, versus look at what Standard Oil was worth in his generation. So he said that, hey, you really don't know, you don't really know you're in a bubble until it blows up. That's very true. And that always happens in asset classes, where there's a real estate bubble, where's a stock bubble, where's a business bubble, credit bubbles. You always hear of bubbles, but you don't know you're in a bubble until it bursts. So, he's making a comparison to the last generation to this generation with evaluations being drastically higher, making him a very, very, very wealthy man. But he's just saying how the times have changed. Can we keep this up?
Companies of America behave more like biology than they do anything else. In biology, all the individuals die, and so do all the species. It's just a question of time. And that's pretty well what happens in the economy too. All the things that were really great when I were young have receded enormously, and new things have come up, and some of them started to die. And that is what the long-term investment climate is. And it does make it very interesting. Look at what's died. All the department stores, all the newspapers, U.S. Steel, John D. Rockefeller's Standard Oil, the pale shadow of his former self. It's just like biology.
So
they have their little hour, they have their little time, and then they get clobbered. Well,
now he just made a very good point. He said companies are like biology, where they have a little period and they die. Right now, if you can imagine a world right now where Amazon is not the king. Most people look at me like I'm crazy. Well, Google is not the king. We live in a world where Google and Amazon and who is that? Google, Amazon, Facebook. Who else is up there? Google, Amazon, Facebook. I'm trying to think of all the companies that call to the committee meeting. Apple. You're looking at all these particular companies, just those four. Let's focus on those. I know I'm missing one of them. But look at those companies. People can't imagine a world without those companies dominating in 2021. They dominate everything that we do, essentially. Social media is ran by Facebook. You're looking at Apple that's running the computer world. You look at Amazon is the largest giant right now this time. So he's speaking back in his era. He was saying, hey, newspaper ran the world. You look at Rockefeller Oil ran the world. Railroads ran the world. Department stores ran the world. And he said, hey, look, companies are like biology. They have a moment and then they die. They have a moment and then they die. So when he's saying that, hey, yes, what's on top today will not be on top in 20, 30 years. Look at Walmart. Can we imagine a world without Walmart? You know who's going to replace Walmart? No. He said there will be a disruptor that will come along. Look at how the internet came along and pretty much just killed newspapers and magazines, killed print. Look how the internet came along and kind of starting to kill radio and television. Who would have thought that? So what he's saying is that companies are like biology. Somebody, you'll have a moment where you, like a plant, it will grow, then it will become a tree, then it will dominate, then guess what? It will die. So I know right now at this recording, if I told anybody, can you imagine a world where Amazon, Facebook, Google will die? People can't see that. But there will come a time in a world where that would happen. Look at he's speaking about in his generation. Look at all those things that was the king of his economy got disrupted. And look at all these new companies that came along. The same thing. Yahoo was Google before Google. Yahoo was, right? Now look what Yahoo is and look how Google just came in and took over the thing, right? Took over the internet. So, what is going to take over? And as a long-term investor, you ask yourself the question, well, Prince, if Google, Facebook, Amazon are not going to be the people to take over, well, who will replace them? So let's listen to a little bit more.
Some people try to get on the cutting edge of change, so they're destroying other people instead of being destroyed themselves. And those are the Googles and the Apples and so forth. Mm-hmm. Other people like me do some of that, joining things like Apple, and in some ways we just try and avoid big change that we think is likely to hurt us. And so Berkshire, for instance, owns the Burlington Northern Railroad. You can hardly think of a more old-fashioned business than a railroad business. But who in hell's ever going to create another trunk railroad? So it's a very good asset for us. So, and we've made that success not by conquering change, but by avoiding it. Now, Burlington Northern itself has been quite clever at adapting technology to their railroad. Imagine the good luck of being able to take an existing railroad and double deck all the trains and raise the heights of the tunnels a little and so forth. And all of a sudden you got twice the capacity at very little incremental cost, which is what that railroad has done.
So that is a
So everybody.
Now he just spoke about, well, going into the world of disruptors, because something will disrupt you. How do you invest? So he said, hey, we do a little bit of that with Apple, the companies that come in and disrupt. And then I stay with the old school companies like a railroad. Like, what is more old school than a railroad? So what's more old school than a railroad is nothing really. He's saying, hey, how can you disrupt the railroad? So he said, hey, I invest some money into things that cannot be disrupted. And then I invest my money into things that are the disruptor. So, looking at the long-term way, he's saying, hey, we got a little bit of Apple, and then we got something as old school as a railroad.
Everybody uses new technology, but it really helps to have a position that almost can't be taken away by technology. How else are you going to carry goods from the port of Los Angeles to Chicago, except on our railroad? I spent a lifetime trying to avoid my own mental biases. I rub my own nose in my own mistakes. B, I try and keep it simple and fundamental as much as I can. And I like the engineering concept of a margin of safety. I'm a very blocking and tackling kind of a thinker. I just try and avoid being stupid.
So,
and I have a way of handling a lot of problems. I put them on what I call my too hard pile, and I just leave them there. I'm not trying to succeed in my too hard pile. What I would say is the single most important thing, if you want to avoid a lot of stupid errors, is knowing where you're competent and where you aren't, knowing the edge of your own competency. And that's very hard to do because the human mind naturally tries to make you think you're way smarter than you are. But partly it's temperament, partly it's deferred gratification. You got to be willing to wait. And it's a weird, good investing requires a weird combination of patience and aggression, and not many people have it. It requires a big amount of self-awareness and how much you know and how much you don't know. You have to know the edge of your own competency. And a lot of brilliant people are no good at knowing the edge of their own competency. They think they're way smarter than they are. And of course, that's dangerous and causes trouble.
All right. So he said pretty much stay in your area of competency, and to stay with what you know. Some people think they're smarter than what they really are, right? And pretty much what he was saying was, hey, some people, you need to be smart to say, hey, I don't know, like me, I don't really understand cryptocurrencies or whatever. So I don't try to act like I'm a genius on it, because some people think they're more smarter than what they actually are. All right. The other thing that he was saying too was to not only stay into your place, but to also balance out your portfolio with something that's going to disrupt and something that cannot be disrupted as well. So anyway, that's Charlie Munger's. I thought I would go out and push that out on this late morning, late morning show, what do you want to call it? So I'm gonna check y'all comments before I head out of here for today. So Guma Squad, hey, what's going on there? I think is that Mario? Not sure, but he says, oh my goodness, why is this thing in my way? Why is that showing in my way? Let me remove it. Okay, he said, I'm here. Lyft up more than Uber. I don't know what you mean, but I think you're saying the Lyft stock is up more than Uber stock. Are you talking about the last week, the last month? Because if you're looking at them from the time they came out, Lyft was at $80 when it came out, 78 to 90. I think it was 78 to $80. If you go back and look at when they IPO 2 years ago, they was like $80, and right now they're at like 60 something dollars, if I'm not mistaken. Uber came out around 40 something dollars and is at 50 something dollars. So when you look at them from the IPO, then yes, I will say that Uber is definitely in the green and Lyft is still in the red. But if you're looking at a shorter time frame, maybe like the last month or two or quarter, then Lyft, I haven't looked at that chart, but maybe Lyft is beating it, but it's definitely not from the time of his IPO. Lyft hasn't even made it back to his IPO price. William says, good morning, Toledo, Ohio. What's going on, William? I'll probably be on later today. P for life. He's out there in Phoenix, Arizona. He said, oh, this is late. I'll watch the playback when I get home. Definitely a good one. I think we did. Somebody on Facebook said, this is interesting. Appreciate it. And Goman Swar said, I watched this interview as well. It's good to hear it again. Yes, I thought I'd take out some pieces there. He also spoke on Robinhood as well. I'll probably have to do another cut on that one with him and Julian LaRoche. But yes, hopefully y'all took something out of this. And we got a couple more people. Giant 864 says, listening to this while heading to work. Oh, nice, good. Hopefully you got something out of it. And enjoyed it. Tyrese Lewis said, good morning. Hey, what's going on there, Tyrese? But anyway, ladies and gentlemen, that's going to conclude this quick episode that I want to do about Charlie Munger going into the next decade. If you didn't get a chance to catch it out, you can always catch it on all of our podcasts, anywhere you can catch a podcast. You can catch a playback here on YouTube. All those are a good thing. So anyway, ladies and gentlemen, boys and girls and children of all ages, that's going to conclude today's topic. And to the next video podcast, cartoon, or whatever else crazy you see me doing around the globe, peace, be safe. I'm out, and thank you.